Let's take one company, Industrial and Commercial Bank of China, ICBC, one of the largest banks in the world by assets. The same institution, the same balance sheet, the same dividends. Now take that company and look at its share price in Shanghai, and then look at its share price in Hong Kong. On any given day, the Shanghai listed shares can trade at a meaningful premium to the Hong Kong listed shares, sometimes 20% more, sometimes more than that. The same company, different price, different city, different investor base. This is not a pricing error. It is not arbitrage waiting to be closed. It is a structural feature of how Chinese equity markets are organized, and it persists because the markets are deliberately segmented, with different rules about who can buy what and where. Understanding why requires understanding the four main Chinese share classes, A, B, H, and N. This episode explains each one, what it is, who trades it, what kind of companies you find in it, and how it behaves differently from the others. Welcome to the China Memo. We make unbiased observations on structural trends. I'm your host, born in China, trained in Western finance. Every Chinese share class answers the same two questions differently. First, where is the company listed and in what currency does it trade? Second, who is allowed to buy it? The answers to those two questions determine the character of each share class, its investor base, its typical valuation, its volatility profile, and what kind of companies you find inside it. Keep these two questions in mind as we go through each one. A shares are the core of the Chinese equity markets. A company with A shares is incorporated in mainland China, listed on either the Shanghai or Shenzhen Stock Exchange, and trades in renminbi. This is the domestic market in the most direct sense. Chinese companies on Chinese exchanges in Chinese currency. For most of the market's history, A shares were only available to mainland Chinese investors. Foreign investors were formally excluded. That changed in stages. First through the QFII program, Qualified Foreign Institutional Investor, which allowed selected overseas institutions to apply for quotas to invest in A shares. Then through the RQFII program, a renminbi-denominated version of the same concept, and most significantly through Stock Connect, a link established in 2014 between Hong Kong and Shanghai, later extended to Shenzhen, that allows investors using Hong Kong stockbrokers to buy and sell certain A shares without requiring a special license. Think of Stock Connect as a controlled gate. It opened access to A shares for international investors while keeping the domestic market's basic architecture intact. What do A shares actually contain? A lot. The A share market is by far the largest and most diverse slice of Chinese equities. You find the country's largest state-owned enterprises, the big banks, the oil companies, the telecoms, the infrastructure groups. You also find large private sector companies in consumer goods, healthcare, and manufacturing. And on the growth boards, Chinex in Shenzhen and the Star Market in Shanghai, you find thousands of smaller, faster-growing companies in technology, biotech, new materials, and advanced manufacturing. A shares have a specific behavioral character that follows from their investor base. Historically, roughly 70 to 80% of daily trading volume in A shares is driven by retail investors, individual Chinese citizens making their own investment decisions. That is an unusually high retail share compared with most developed markets. However, we need to separate liquidity velocity from asset ownership. While retail day traders drive such high daily transaction volume through high turnover trading, they actually own less than 30% of total market capitalization. The vast majority of the asset base remains locked up with state corporations, domestic institutions, and foreign funds. Nevertheless, because retail accounts dominate the daily liquidity pool, it creates a market that is sensitive to sentiment, prone to momentum cascades, and responsive to policy signals in ways that can amplify price moves in both directions. This is why A shares can look statistically volatile relative to their economic fundamentals. The volatility is not random. It reflects the retail-dominated structure of the market and the way retail sentiment interacts with policy news. B shares are a legacy share class, worth understanding, perhaps not worth spending too much time on. A company with B shares is also incorporated and listed in mainland China, but the shares trade in foreign currency rather than renminbi. In Shanghai, B shares trade in US dollars. In Shenzhen, they trade in Hong Kong dollars. B shares were created in early 1990s as a mechanism for foreign investors to access Chinese companies at a time when A shares were close to them entirely. The idea was to create a parallel track, same country, same companies, but in a currency foreigners could use. The mechanism became obsolete as A shares gradually opened to foreign investment through QFII and Stock Connect. There is almost no appetite for new B share listings now. The universe is small and shrinking. Liquidity is thin. Most global investors do not use B shares for China exposure today. The one interesting footnote is the valuation relationship. In the early years of B shares, they traded at a discount to A shares, partly because foreign investors were cautious about China risk and partly because the investor base was smaller. That relationship has shifted over time as A shares opened up and the domestic investor base grew more confident. But the B share market itself remains a minor footnote rather than an active investment category. H shares are mainland Chinese companies listed in Hong Kong. A company with H shares is incorporated in mainland China, but its Hong Kong listing allows it to raise capital from international investors and trade in Hong Kong dollars. Any investor who can access the Hong Kong Stock Exchange, which is to say, any investor globally, without special licenses or quotas, can buy H shares. H shares were for many years the primary way international investors obtained exposure to large Chinese companies. Before QFII, before Stock Connect, before any of the mechanisms that opened A shares to foreign capital, H shares were the default channel. The large Chinese state-owned banks, insurance companies, oil and gas groups, and infrastructure companies that needed to raise capital from international markets went listing in Hong Kong specifically to access that investor base. The result is that the H-share universe is heavily weighted toward large SOEs, that is, state-owned enterprises and financials. ICBC, Bank of China, PetroChina, China Memo, these are H-share names. They are also often A-share names. Many of the largest Chinese companies have dual listings, an A-share trading in Shanghai and a H-share trading in Hong Kong simultaneously. This brings us back to the opening anomaly. The AH premium is the gap between the price of the same company's A shares and H shares. The A shares trading in Shanghai, accessible primarily to domestic investors, consistently command a premium over the H shares trading in Hong Kong. Several factors sustain that gap. Capital controls prevent Chinese investors from freely moving money out of China to buy H shares instead. The domestic investor base has a different risk appetite and a different return expectations from the international institutional investor base that dominates Hong Kong trading. And the market segmentation means arbitrage, the mechanism that normally closes price gaps, cannot operate freely across the border. If you are looking at a company that is dual listed and you want a cheaper entry point, the H share is almost always the lower priced option. Whether the discount is justified or whether it represents genuine relative value depends on factors that go beyond the share price itself. H shares are also generally more institutionally traded and less retail driven than A shares. The Hong Kong market is estimated to be 70 to 80% institutional by trading volume. That tends to produce a more fundamentals-driven price process and less sentiment-driven volatility than the A-share market. Although H shares are certainly not immune to sharp moves when global risk appetite shifts. A frequently overlooked friction sustaining this premium is tax asymmetry. Mainland retail investors accessing Hong Kong H shares through the Southbound Stock Connect face a mandatory 20% withholding tax on dividends. This tax friction dilutes the net yield relative to onshore A shares, meaning that even when Hong Kong listings look fundamentally cheap, cross-border tax architecture actively deters the domestic capital that would otherwise close the gap. N shares are Chinese companies listed in the United States. The specific mechanism is usually an ADR, an American Depository Receipt. Think of an ADR as a wrapper. A Chinese company deposits its actual shares with a US bank, which then issues receipts that trade on the US exchange in US dollars. Investors in New York are buying the receipt, which represents an economic interest in the underlying Chinese company. Most N-share companies are not incorporated in mainland China. They are typically incorporated in Cayman Islands or another offshore jurisdiction, a structure that allows them to use variable interest entity arrangements, which are the legal mechanism Chinese internet companies use to list offshore while maintaining domestic operating licenses. It is a complex structure born from the regulatory reality that foreign ownership of certain Chinese businesses is restricted. The offshore incorporation creates a contractual claim on the economics of the Chinese operation rather than direct equity ownership. N shares are where China's major internet and platform technology companies have historically listed. Alibaba's primary listing was in New York. Before 2021, the N-share universe was the primary way international investors accessed China's digital economy. The political environment around N-shares has become significantly more complicated since 2020. Regulatory pressure in China on internet platform companies reduced the earnings and growth expectations for many N-share names. At the same time, US regulatory pressure, specifically requirements that Chinese companies listed in the US provide access to their audit working papers, which Beijing had historically resisted, created the risk of forced delistings. Many companies responded by adding or shifting primary listings to Hong Kong, reducing their dependence on the New York market. N-shares now carry a different risk profile than they did 5 years ago. They are sensitive to both Chinese regulatory cycles and US-China geopolitical tension, two variables that can move independently and can compound when they move in the same direction. Now, let me close with the practical version. If you want exposure to China's domestic economy, consumption, manufacturing, industrial upgrading, healthcare, clean energy, you are looking at A shares. The onshore market is where most of that activity lives. Access is available through Stock Connect products and A-share ETFs that use the QFII RQFII mechanism. If you want large Chinese state-owned enterprises, banks, energy, telecoms, infrastructure, with international accessibility and no special account requirements, you are looking at H-shares in Hong Kong. You are also likely looking at a discount to the equivalent A-share price. If you want exposure to China's internet and platform technology companies, particularly those with significant international business or that were built during the digital economy boom of the 2010s, you are looking at N-shares and Hong Kong-listed technology names. However, be aware of the dual regulatory exposure those shares carry. And B shares, unless you have a specific reason, you don't need them. The universe is too small, the liquidity too thin, and the access mechanisms that made them necessary in the 1990s have long since been suspended. The four labels A, B, H, N are not just categories. They are the result of different historical moments, different policy decisions, and different investor access regimes. Knowing which one you are in tells you something about the rules of the market you are operating in. And in China's equity markets, the rules vary considerably depending on where you stand. A shares, B shares, H shares, N shares. Same country, very different markets. The AH premium, where the same company trades at different prices in Shanghai and Hong Kong, is not a curiosity. It is a visible symptom of how deliberately segmented Chinese capital markets remain, even after decades of gradual opening. That segmentation shapes valuations, drives investor behavior that make China's equity markets genuinely different from any other major market in the world. Understanding the terrain is the prerequisite for reading the map accurately. This has been the China Memo. Thank you for listening. Before I go, nothing in this episode constitutes investment advice or a trade recommendation. The China Memo is based on publicly available sources. For financial decisions, please seek qualified independent advice.